Sarah drops her phone on the kitchen counter and stares at the number on the screen. $314,000. She picks up the phone again, opens the compound interest calculator for the fourth time this morning, and enters the same numbers. $35 per week, 10% annual return, 30 years. The result doesn't change. She sets the phone down and looks at the coffee maker on the counter, the one with the timer that brews automatically every morning so she doesn't have to stop at the drive-thru on her way to work anymore. That's less than most people spend on coffee and lunch. But when I ran the math on what that actually compounds to over a working career, using real historical market returns, one number stopped me cold. After 30 years, you're not looking at $50,000 or even $100,000. You're looking at a six-figure portfolio that could generate meaningful income in retirement, from what amounts to skipping 2 takeout meals a week. So the question I wanted to answer is this: is that realistic? Or is it one of those sounds good on paper scenarios that falls apart when you account for taxes, inflation, and the actual behavior of markets over multi-decade periods? Here's what we're modeling. And you don't get bored and chase the next hot stock after 6 months of boring index fund returns. Consistency is the entire mechanism here. If you can't commit to that, the rest of this is irrelevant. Let's start with 10 years. You're contributing $1,820 a year. That's $18,200 total out of your pocket over the decade. At a 10% average annual return, compounded monthly, that grows to roughly $31,000. Now, here's the part most people miss when they hear that number. You didn't just earn $13,000 in gains. You earned $13,000 while the market went through at least one, probably two, significant corrections during that period. The 2010s had a near 20% drop in late 2018. The 2000s had 2 separate bear markets that cut the index in half. The point is that $31,000 endpoint assumes you kept buying through all of it. In fact, you bought more shares when prices were down, because your $35 a week bought more units when the market was cheaper. That's dollar cost averaging in action, and it's the only reason this math works in practice. But here's the tension. $31,000 after 10 years isn't life-changing money for most people. It's a solid start, but it's not retirement. It's not financial independence, and that's where a lot of people quit because the early years of compounding feel slow. The gains are real, but they don't feel dramatic yet, because the base you're compounding off of is still small. This is the danger zone where behavior breaks the math. Marcus checks his brokerage account on his lunch break and sees the balance sitting at $28,000. He's been contributing for 9 years now, every single week, even through the correction 2 years ago when his account dropped to $19,000 and stayed there for months. His coworker leans over and asks what he's looking at. Marcus shows him the screen. His coworker does the mental math and says, "That's not bad, but he made almost that much last year trading options on his phone." Marcus closes the app and goes back to his sandwich. He knows his coworker also lost $12,000 the year before on those same trades, but he doesn't say anything. He just opens his banking app and confirms that this week's automatic transfer already went through. $35. Same as always. Now let's go to 20 years. You've contributed $36,400 total. At the same 10% annualized return, that portfolio is now worth approximately $115,000. Notice what just happened. In the first 10 years, you added $18,200 and ended with $31,000, a gain of about $13,000. In the second 10 years, you added another $18,200, but the portfolio grew by $84,000. Same contributions, but the gains in the second decade were more than 6 times larger than the first. That's not because the market did better in year 11 through 20 than it did in year 1 through 10. It's because the base you're compounding off of is now $31,000 instead of 0. You're earning returns on your contributions and on the gains from the prior decade. This is the inflection point where compounding starts to feel real. But here's the part that gives me pause when I talk to people about this. 20 years is a long time. It's longer than most people stay at one job. It's longer than most people stay in one house. And it requires you to keep contributing through at least two, maybe three full market cycles, including at least one period where your account balance drops 30 to 40% from its peak and stays there for a year or more. That hurt, but your weekly contributions were still making a visible difference. You could see the balance climbing back up as you added money. In year 20, when your balance is $115,000, a 10% drop means your account goes down $11,500 in a matter of weeks. Your $35 weekly contribution doesn't even register against that kind of movement. You're contributing $140 a month into an account that just lost $11,000. It feels pointless. This is where the psychology gets harder, not easier, even though the math is working exactly as it should. But here's the thing that keeps people going at this stage. The gains in year 15 through 20 are so much larger than anything that happened in the first decade that you start to see the machine working. You look at your statement in December and realize you contributed $1,820 that year, but your account grew by $14,000. You didn't do anything different. You didn't pick better stocks. You didn't time the market. You just kept doing the same thing you've been doing, and the compounding finally got big enough that you can see it happening in real time. That's the psychological shift that happens somewhere in the second decade. The math stops being theoretical and starts being visible. David opens his quarterly statement and sees his balance at $108,000. He's 49 years old. He started contributing when he was 29, right after he got his first job that offered a retirement plan. He remembers thinking $35 a week seemed like a lot back then. He was making $32,000 a year and trying to pay off student loans. But he set up the automatic contribution anyway, and then he just stopped thinking about it. He didn't check the account for the first 5 years, didn't look at it during the 2008 crash, didn't touch it when he changed jobs twice and rolled it over both times. He just let it run. Now he's looking at a number that's 3 times what he contributed, and he realizes he's only halfway through the timeline. He opens the calculator on his phone and runs the math for another 10 years. The number that comes up is $270,000. He stares at it for a long time. Then he closes the app and goes back to work. The 20-year mark is where the math proves itself, but only if you make it there. And most people don't, not because the strategy doesn't work, but because 20 years of discipline is harder than it sounds when you're standing at year 1. The market will give you every reason to quit. It will drop when you least expect it. It will stay flat for years at a time. It will make you feel like you're doing something wrong because everyone around you seems to be making faster money doing something else. But the math doesn't care how you feel. It just keeps compounding week after week as long as you keep feeding it. Now, 30 years. You've contributed $54,600 total. Still just $35 a week, never increased. At 10% annualized, that portfolio is now worth approximately $314,000. Let me say that again. You put in $54,600. The account is worth $314,000. That means $260,000 of that balance is gains. Money you didn't contribute. Money the market generated by compounding your contributions over 3 decades. In the third decade alone, the portfolio grew by about $200,000, even though you only added $18,200 in new contributions. The math is now working almost entirely in your favor. You're earning returns on 30 years of prior contributions and 30 years of prior gains. The snowball is massive. Here's what that means in practical terms. If you're 30 years old today and you start this, you're 60 when you hit that number. $314,000 conservatively allocated in retirement could generate $12,000 to $15,000 a year in income using a 4% withdrawal rate adjusted for inflation. That's not replacing a full salary, but it's a meaningful supplement to Social Security, and it came from skipping 2 lunches out per week for 3 decades. But, and this is the part I keep coming back to, 30 years is longer than most people's investing horizon when they start. If you're 40 today, you're 70 at the end of this. If you're 50, you're 80. The math still works, but the time horizon shrinks, and that changes the risk profile. A 30-year-old can ride out a decade-long bear market because they have 2 more decades to recover. A 55-year-old can't. So the question isn't just does the math work? It's do you have the time horizon for the math to work? Now let's talk about where this model falls apart in the real world, because it absolutely can. First, the 10% return assumption. That's the historical average, but it's not guaranteed and it's not evenly distributed. The S&P 500 returned 18% annualized in the 1980s and 90s. It returned basically zero from 2000 to 2009 when you account for inflation. If your 30-year window happens to include a lost decade at the front end, your results will be significantly worse than the model because you'll be contributing into a flat or declining market for 10 years with no compounding gains to show for it. Japan's Nikkei index is still below its 1989 peak, 35 years later. That's an extreme example, but it's a reminder that stocks always go up over the long term is a historical observation, not a law of physics. Second, behavior. The math assumes you never stop. But I've seen the data on actual investor behavior, and it's brutal. The average equity fund investor underperforms the funds they invest in by 1 to 2% per year, according to Dalbar's studies, because they buy high, sell low, and chase performance. If you do that even once or twice over 30 years, you will not get the $314,000. You'll get a fraction of it. And you'll spend the rest of your life wondering why the math didn't work for you when it worked for everyone else. Third, life happens. Medical bills, job loss, divorce, a kid who needs help with college. The model assumes you have $35 a week of truly discretionary income for 30 consecutive years. Most people don't. And if you have to stop contributing for 5 years in the middle, or if you have to pull money out, the compounding resets. You don't just lose the contributions you missed. You lose the decades of compounding those contributions would have generated. And fourth, this is the one that concerns me most right now, valuations. The S&P 500's CAPE ratio, which measures price relative to 10-year average earnings, is currently around 35. The historical average is 17. That doesn't mean the market is about to crash, but it does mean that future returns are likely to be lower than the historical average because we're starting from a higher valuation base. If the next 30 years look more like 7 to 8% annualized instead of 10, that $314,000 becomes $210,000. Still meaningful, but not the same outcome. But here's the other side of that, because I don't want to end on pure pessimism. One, even if returns are lower, the math still works. It just works slower. $210,000 after 30 years is still a 4 times return on your contributions. That's still compounding. That's still wealth you didn't have. 2, this model assumes you never increase your contributions. But in reality, most people's income grows over time. If you start at $35 a week in your 30s and you're able to bump that to $50 a week in your 40s, or $75 a week in your 50s as your salary increases and your kids move out, the endpoint number goes up significantly. Even small increases in the contribution rate have an outsized impact on the final balance because those extra dollars get decades to compound. 3, this is just one account. If you're doing this in an IRA or 401k and your employer is matching even part of your contribution, you're effectively doubling your input without doubling your out-of-pocket cost. A 50% match on $150 a month is an extra $75 a month you didn't have to pay for. That alone could push the 30-year number well past $400,000. And 4, the alternative is worse. If you don't invest this money, it doesn't just sit in a pile, it gets spent. $35 a week over 30 years is $54,600 that either compounds into $314,000 or it turns into nothing because you spent it on things you don't remember. The opportunity cost of not doing this is enormous, even if the market underperforms. So here's what I think this means if you're actually considering doing this. First, the math works, but only if you have the time horizon and the discipline to let it work. If you're under 40 and you can commit to 30 years of consistent contributions, this is one of the most reliable wealth building tools available to regular people. If you're over 50, the math still works, but you need to be more conservative about your return assumptions and more realistic about your risk tolerance because you don't have 30 years to recover from a bad decade. Second, this only works if you build the foundation first. You need an emergency fund. You need to be out of high-interest debt. You need to know that $35 a week is truly discretionary, not money you're going to need back in 6 months. If you skip that step, you will break the compounding chain and the math falls apart. Third, automate it. The reason dollar cost averaging works is because it removes the decision from your hands. Set up an automatic transfer from your checking account to your brokerage account every week and let it run. If you have to manually decide to invest every week, you will skip weeks. You will talk yourself out of it when the market is down. Automation is the only way most people actually execute this consistently. And fourth, this is education, not advice. I'm showing you what the math looks like based on historical data, but I'm not telling you this is the right strategy for your specific situation. If you're serious about this, talk to a licensed financial advisor who can look at your full financial picture, your income, your debt, your goals, your risk tolerance, and build a plan that actually fits your life. This video is a starting point, not a finish line. The bottom line is this: $35 a week sounds like nothing, but compounded over 30 years, it's not nothing. It's a six-figure portfolio. The question is whether you're willing to treat it like it matters every single week for 3 decades. Most people won't. But if you do, the math is on your side. If you want to see how this math changes if you increase the contribution rate, or if you want me to break down the tax implications of doing this in a Roth IRA versus a taxable account, let me know in the comments. And if you found this useful, subscribe. I'm going to keep walking through the math on long-term investing strategies that actually work for regular people, not just the ones that sound good in a headline.